Welcome to The Explainer. Today we are jumping right in to break down a really thorough analysis of the Canadian infrastructure company ATCO Ltd. We're going to figure out if this is just a stable, maybe boring utility, or if there's a real hidden growth opportunity here.
So here's the big question we're trying to answer. Is ATCO's stock priced correctly for what it is, a steady utility, or does it have the potential to be a long-term compounder, a real wealth builder? Basically, is the market getting this one right?
Here's our game plan. We're going to follow the analyst's journey step by step. First, we'll get to know the business. Then, we'll give it a full financial health check. After that, we'll look at its strengths and weaknesses, calculate its real intrinsic value, and finally, get to the bottom line for an investor.
All right, first things first. What exactly is ATCO? What do they even do?
Think of ATCO as having two main engines. On one hand, you've got its regulated utilities. We're talking electricity and gas networks. These are great because they bring in steady, super predictable cash. The other engine is its bigger infrastructure projects, like building modular structures, which is a bit more up and down and needs a lot of capital.
Okay, so that's the business model, but how does it all look on paper? Let's pop the hood and take a good look at the company's numbers. All right, here's a quick look at the vital signs from the time of this analysis. A couple of things really jump out at me. A solid market cap around $6.7 billion, but whoa, check out that debt, over $13 billion. That definitely stands out. And you get a dividend yield of just over 3%.
Now, this next part is absolutely crucial. You've got to understand the lens we're looking through for the rest of this. The entire analysis is based on hitting one specific goal, a 9% average return every year for 16 years. That's our North Star for everything that follows.
And look at this. When it comes to its main business, the company is an absolute cash machine. It's pulling in nearly $2.5 billion from its core operations. That's really strong, and it's pretty much what you'd expect from a stable utility company. But, and this is a big but, where is all that cash going? Despite all that money coming in from operations, the company's free cash flow is actually negative. That means every single dollar it makes, plus a little extra, is being pumped right back into the business for new projects and upkeep. It is reinvesting like crazy. And this right here, this is where things get really interesting and maybe a little concerning. All that reinvestment should be leading to great profits, right? Well, its return on equity is only around 3%. When you compare that to its peers, who are typically in that 8 to 12% range, you have to ask, is all that money being put to good use?
Okay, so we've got the numbers. Now let's zoom out a bit and look at the bigger picture, the company's overall strategy and its position in the market.
So what's ATCO's biggest advantage? It really comes down to this one idea. It's moat. The company owns critical infrastructure, stuff that's practically impossible for a competitor to build right next to it. I mean, you can't just set up a competing set of power lines. That creates a massive barrier to entry that protects its business.
So this table kind of puts it all together, the good, the bad, and the ugly. And that final score, 5.55 out of 10, what does that tell us? Well, it's pretty much middle of the road. It's not a disaster, but it's not a home run either. You can see its strengths, like that stable business, are getting dragged down by weaknesses like the high debt and low profitability we just talked about.
And diving a little deeper into those weaknesses, we see some major red flags here. That huge debt load is a big one. The low ROE points right back to that concern about whether they're using their capital efficiently. And then there's the dividend, which is costing them way more than they're making in earnings. These are some serious headwinds for an investor to think about.
All right, this is the moment of truth. After looking at the business, the numbers, the risks, what is this company actually worth?
Okay, brace yourselves, because this slide really tells the story. On one side, you have the market price, $67 a share. On the other, you have the analyst's estimate of its real intrinsic value, $34.50. Wow. I mean, the stock is trading for almost double what this analysis says it's fundamentally worth.
And you might be thinking, well, maybe that's just a pessimistic valuation. But even if we look at a few different scenarios, the story doesn't change much. Even in the best case, most optimistic scenario, the value only gets up to $48, which is still a long way from that $67 market price.
So in the world of value investing, there's this crucial concept called a margin of safety. It's like a buffer, right? A discount that protects you if things go wrong. And ATCO, well, it doesn't just lack a margin of safety. According to this analysis, it has a negative one. You're not getting a discount. You're actually paying a premium, and that leaves very little room for error. So what does this all mean for a potential investor? Let's put some hard numbers on it. Based on all this, what price would actually make sense to pay? Remember our goal, that 9% annual return we talked about? To hit that number over the long haul, this analysis says you would need to buy ATCO stock for around $31 a share. That's, wow, less than half of what it's trading for today.
And this is pretty cool. It shows how your timing changes things. If you're only planning to be in for 5 years, you could pay a little more, maybe $43. But for that true long-term 16-year hold, the price you need to pay drops all the way to $31. The longer you hold, the bigger the discount you need up front.
All right, let's wrap this all up. What's the final verdict? ATCO is a solid, stable, defensive company with a great business model, no doubt about it. But its profitability is low, and it's not using its cash as efficiently as it could be. And the biggest takeaway is that the stock appears way, way overvalued. For an investor looking for that 9% return, there's just no margin of safety at the current price. A much better entry point would be down in that $30 to $32 range.
So there you have it, a deep dive into ATCO. It's a classic example of how a perfectly good, stable company isn't always a good investment at any price. We hope this explainer was useful. And now we want to hear from you. What company do you want us to break down next? Let us know in the comments below.